question that pretty much comes up in every client conversation, and that's whether or not the inflation pressures we've seen, will they be permanent, right? Transitory is the big word right now. Inflation is transitory. But what are your thoughts on this? Will the inflation in the economy and what it's experiencing, will it be fleeting, or is it indeed here for years to come?
Yeah, that's definitely what everyone is trying to figure out right now. And myself and the consensus amongst our investment committee, and we've remained steadfast in this, over the course of last year, is that the inflation, that we're experiencing right now will be transitory. And the recent spike has been a result of a couple different things, but it's really been just the supply and demand mismatch, that's been resulting from bottlenecks in the global supply chain, and obviously a tremendous amount of pent-up demand as the economy reopens. And so, again, the data has been extremely noisy, and even the most accurate economic forecasters have been looking through a lot of these inflation anomalies and some of this economic data, generally speaking. But at some point, these issues will dissipate, in our view, and in time, once again, a lot of the COVID-related disruptions will heal. Inflation is a very, very difficult thing to generate, as we saw in the last economic cycle. But I remain more concerned about how the labor market may contribute to inflation longer term, as opposed to the short-term supply and demand imbalance really being a permanent problem. So I'll get back to the labor market and some of those concerns in a second, but the supply and demand imbalances had a couple causes. First, on the demand side, fiscal support, was showing earlier, retail sales, looking at consumer income, especially the last round of stimulus checks, it's pushed demand for durable goods. And so these are goods like televisions and furniture and technology and computers and all these sorts of things that aren't consumable, to levels that are 15 to 25% above pre-pandemic levels. So again, durable good orders have been about 20% above pre-pandemic trend. And again, on the supply side, we've seen production pullbacks as a result of the pandemic. We've seen supply chain disruptions. Semiconductor shortage has been well reported by the financial news, which has constrained auto production and various other things. And obviously problems with global shipping. Global shipping has, experienced a number of problems within the last couple of months, and it may seem silly, but there's been a tremendous shortage of shipping containers. I'm sure if you Google shipping container prices, you'll see just how violently the prices have surged as manufacturers are looking to ship things around the world. Suez Canal blockage, again, may seem silly, and I'll never forget seeing that little bulldozer next to that huge ship trying to get it out as the global supply chain basically comes to a screeching halt. But definitely clogged ports, clogged Suez Canal. And we've also seen COVID outbreaks in some of these key ports across the country. And so all these things have slowed delivery and substantially increased shipping costs. Just a little anecdotal story. I'm purchasing a chair. It was the wrong one. I had to ship it back. And I was just curious. I wanted to see what the cost of this would be. It's about a 3-foot package. It was a chair and an ottoman. And I looked on FedEx, and again, they're not a freight shipper, but they wanted to charge us $2,500 to get it back to Portland, Oregon, from the Philadelphia suburbs. And ultimately, we found somebody that was able to be a tenth of the price. But regardless, unbelievable really disruptions within the supply chain that I don't think are talked about enough, ultimately creating pricing pressure now that we can't bring supply to market. And so again, the question is when will this diminish? We've seen from a lot of quarterly earnings calls, with CFOs. They expect that things will really start to get much better in the third quarter, this quarter, especially in the appliance side of things, the semiconductor side of things. There's new factories opening. And so also, I think some of the demand will fade as a lot of U.S. consumers in particular will shift less so away from durable goods and more to services and going back to experiences and travel like they once were. And so I think on the supply side and on the demand side, we'll see things lighten up quite a bit. And it could be, toward the end of the fourth quarter, we've already seen, lumber prices normalize quite a bit in just a short period of time. So other manufacturing industries, we've seen low inventory levels. And so now that they're operating at above average utilization rates, U.S. and foreign good producers have opportunity to raise utilization rates even further to bring more supply to market. And so ultimately, it's created some severe pricing pressure, right? And as we saw in this last CPI report that came out not too long ago, just a couple days ago actually, that June report showed that consumer prices rose by 5.4% year over year, which was the highest since August of, August 2008, 13 years ago. Hard to believe. But a third of that price increase in the index came from used car prices alone. So of that 5.4%, a third came from just this insane rise in used car prices. I think it was up somewhere around like 10.4%, but just an incredible move. And again, not one that we expect to really linger too much longer.
And that's why I'm not buying another used car for a while. I'll just keep driving my Accord as long as I can, no matter what my wife says. So looking out beyond 2021, what do you see to be the risk for inflation?
Yeah, so I think it's getting back to what I promised I'd come back to, which is the labor market. Inflation could be this self-fulfilling prophecy to a degree, but market measures of inflation expectations also agree that the pressures will be somewhat temporary over the next year or two, and then diminish, in the year to come. I could see inflation moderating to about 3% by the end of this year, year over year. I think that would be a reasonable expectation, and then likely getting actually below 2% in 2022. But obviously we'll have to see how things unfold with how quickly we can get the supply chain back up and running in the global economy, and just how quickly some of the stimulus effects from a consumer spending perspective ultimately begin to subside. But I do think there's a legitimate question as to whether or not there's enough labor available to address the current market imbalances. And ultimately, the labor market, as we're just discussing, is facing these widespread worker shortages, and reopening services industries will need to hire more workers too. We think these worker shortages will diminish, as I mentioned earlier, largely due to the expiration of the unemployment benefits, helping substantially increase labor supply. And by September, we expect about 5 million workers to lose those extended duration benefits. I might have mentioned that earlier. 3.5 million Americans will lose their $300 a week federal top-up for unemployment benefits, and 6 million Americans will lose benefits from the pandemic unemployment assistance program. And so while there's plenty of people who have come back into the labor market, have already started to work part-time, there's enormous demand for workers right now, as we'll see in the JOLTS report. It's a little bit of an inside baseball chart, but really what it shows is basically market participants, investors, large, obviously, firms, even meaningfully bigger than ours, and there's something called swap contracts. And so a swap contract is, let's say it's Chris and I, one of us would pay a fixed rate, and so let's say that's me, and I'm going to pay 2% to Chris on over time, and he's actually going to take the floating rate, which is linked to CPI, and so he would have to pay me the net of 2 versus the floating rate. And so these contracts are used a lot for hedging. Ultimately, a large portfolio, a lot of insurance companies use swap contracts, financial institutions and banks. And so what this shows is that market participants are really expecting that ultimately in the next 5 years, inflation will be meaningfully lower than it will be in the next 2. So seeing that jump down like it has is sort of giving you I hope some confidence there that it's not just me and Chris and the rest of the investment committee feeling this way. There's quite a bit of money behind obviously that view as well. And so definitely clear evidence that a tightening U.S. labor market has been adding to this wage growth, though. On the onset of the pandemic, I mentioned unemployment rate at 3.5% in December of 2019. We started to see some serious wage growth pressures in the back half of that year. And so this quick recovery from the pandemic basically ultimately means much less time for labor market slack to erode wage growth. And ultimately, with the sharp decline in immigration, even before the pandemic, limiting U.S. labor supply and the highly political nature of immigration debate, I think suggests that this trend of not having enough workers could continue for some time. And so all of this points to stronger wage growth in the wake of the pandemic. And conversely, very easy monetary policy could help fuel investment in labor-saving technology, such as robotics and artificial intelligence. And I was actually giving a presentation yesterday at a Chamber of Commerce here locally in the Philadelphia suburbs, and there's a gentleman who has a trucking business that ultimately works with a lot of metals, and he was saying that on the automation side of things, a lot of the products, robots and machines that he used rather than a person to punch steel, Ultimately, of course, they work 24/7. They don't whine. They don't take breaks. They'll have to go out for a smoke break. And the cost of these machines have gone from $150,000 to about $40,000. And so again, as very easy monetary policy and low interest rates again persist, that fuels investment into technologies. Someone like that, and he is, borrowing money from a bank, going out there and buying these machines, ultimately, frees up another person to go take one of those jobs that are so abundant in the market right now, but are ultimately deflationary. And so the most important thing here is, while the labor force participation rate is seeing levels that we haven't seen since the early 1970s, the deflationary forces and the investment that we've seen many companies make and take advantage of low interest rates, borrowing to further the business and reinvest in it long term, ultimately could become deflationary and offset a lot of the tailwinds that we could have by this labor market mismatch as far as supply and demand is concerned. So again, bottom line, we think risks of higher inflation like we're seeing currently likely going to be short term, but we'll be watching very carefully about the labor market to see if ultimately this mismatch, where there's not enough workers, there's plenty of jobs, creates wage pressure much more quickly in the economic cycle than we would normally think.